expires, it's not going to be able to make up all of the deliveries that they lost. And when you take a look at Tesla, it's really more of a global viewpoint. That is what UBS highlighted today. In the world of EVs, they've got three advantages nobody else has. What are they? Backlogs in production, much stronger in terms of where they are now than any of their competitors. Strong margins in pricing. That's not changing anytime soon. And they have supply chain advantages. They've got a head start of many, many years on their competitors. That's what they're taking advantage of, and that's why UBS upgraded them today. And then when you look at NIO, look, it is growing. But remember, NIO comes off a very small base in China. I hear this question from people all the time, Sarah. They're like, what's going on with NIO? It's very small. It's growing, but it's very small.
It is interesting that it's one of the most actively traded names here at the big board every single day, like for the last month.
Yep.
Phil, thank you. Small, maybe people, high momentum there. Phil LeBeau, stocks are sinking here into the close. We're down 2% right now on the S&P. The Dow's down more than 500, and it's the NASDAQ bearing the brunt of the pain, down 2.4%. Ben Emons joins us, Medley Global Advisors, Managing Director of Global Macro Strategy. And Ben, we've been talking about how we've been in this trading range for stocks in the last 10 days or so, and we're starting to break below it ahead of the CPI report. What is today's action telling you?
Hi, Sarah. Yeah, we're in a perfect downtrend, right? It's so technical that way. If you look at the S&P, you're sitting right below the 4,200 level, and the 50-day moving average is moving down, and the 100-day moving average is moving down. So it all points down to further, maybe again to 3,815, that last low, or lower. And it's really the reversal of last year, where every dip was a buy, it's now every peak is a sell. And so I think this is the sentiment here. Obviously, the ECB outcome doesn't help. I think that was also a lot about fears of Eurozone slipping eventually into a recession sooner, and that's, I think, weighing on markets again today too. So you're sitting in this downward momentum.
Energy is faring a little bit better than well, I don't know. Energy's down a bunch today too now. Consumer staples, industrials maybe doing a little bit better. But where are you still in the reopening plays? Does that still work even in this kind of downtrend that you describe?
To an extent, I think. I mean, we have to be encouraged that Asia is reopening, that challenges for China, but it starts to reopen. Take example of Japan. There's actually a big reopening there, a lot of tourism. So some of that global reopening play is still there that you could have as an offensive play, but you have to otherwise be completely defense. It's everything about high dividend, high cash flow yielding type stocks and very low beta stocks in order to weather this environment. They basically huck the flat line, if you will, right? So offense-defense strategies flat on the year so far, but the indices are down 15% or more. So I think that's what you have to stay in until the bottom does hit, and that's an inflation story. It's really clearly about what will happen tomorrow and the following reports that will determine, I think, the bottom in the markets.
So, Mike, when people ask you, how long is the average correction or bear market in history, and what does that tell us about where we are at this point in it? Because it feels like investors have already endured a lot of pain, but everyone keeps saying that we could see another big correction.
Sure. Well, it's been 5 months. I mean, if it's a cyclical bear market, I think that, on average, they go a little bit less than a year. This gets into some semantics here. I mean, we got down to barely above a 20% decline. That's not really the marker of whether this is a bear market or not. To me, it's the breadth of the damage and the fact that it's been going on for months. You're in this defined downtrend, as Ben was saying. So I don't think there's a way to put a marker on it. To me, the big debate is not so much, how long does this typically last? It's if this is a rerun of the major 2000 and 2008, more 2000 style, multi-year, multi-wave downtrends associated with a recession. That's a big if. Then, stop talking about where the bottom is.
Right.
But if not, then this is some kind of major valuation reset that often happens at the outset of a tightening cycle, and you just needed to take care of some, expensive pockets of the market and adjust for lower growth, then arguably, you're kind of there. And, you're down 17% or something like that from the intraday highs. The lows that we saw were about 20%. If there's a retest that was, the lows were 3 weeks ago, if we retest that pretty soon, that's not going to be an unusual pattern. And that's down, whatever it is, a couple hundred S&P points from here.